Hello, it's Craig Tapping from Mastering the Markets, Head Educator and Analyst at Mastering the Markets. Last week I brought you a bit of a valuation guide and talked about the Buffett indicator and also talked about forward PE ratios and how the markets were looking and not looking as expensive as what they seem on the surface when you sort of dig down and you understand what's happening with the earnings. Today I thought I'll take you through a bit of a market scan and what I'm looking at and in both the US markets and how they differ from the Australian markets. So looking at the US equity markets, what we're starting to see is this really big move up in the S&P 500 and a similar really big move, even bigger, in the Nasdaq. And what I've taken is the ETFs, which is the SPY and the triple Qs, to really understand what's happening under the grid and looking at the volume profile of both the SPY and the Qs, and then also looking at breadth. So digging down into the S&P 500 and looking at the stocks that are over the 200-day, the 100-day, the 50-day, and the 20-day moving averages to see what level of participation we have in this rally. So if I go into these charts individually, we can sort of understand how things are stacking up under the hood. And when we look at the S&P 500, and we can see that we had an incredible run from the lows, and for the first 2 weeks we had broad participation. So this is a breadth indicator, and the black line is the 20-day moving average. This is stocks that are over the 20-day moving average, and then the other ones are the 50-day, the 100-day, and the 200-day moving average. And what you can see is for the first 2 weeks we had a really broad participation. That's also seen with the RSP ETF. The RSP ETF is the equal weight ETF. So this sort of takes the 500 stocks and loads them all equally weighted, as opposed to the mega caps and large caps taking up 75-80% of the weighting of the S&P 500. And we rarely get to see that when things are equally weighted, we're not seeing the level of new all-time highs that we're making. In actual fact, the RSP ETF, the equal weighted ETF, hasn't yet made a new high. We haven't taken out the previous high. So even though we are streaks ahead in new highs in the S&P 500, we're not seeing the same in the RSP 500 when you talk about broad participation. We're also going up on declining volume, which is never a sign of strength. And as I said, after the first 2 weeks, we've started to see the participation of stocks in this rally start to really fall off, and we're starting to see breadth decrease quite substantially. Now when we flick over to the Nasdaq, which is more tech heavy, and we start to look at, we're seeing the same sort of picture. Up to this certain point in the first 2 weeks of the rally, we saw broad participation, but since then the participation has diminished quite substantially, and we're starting to see lower lows, lower highs in the breadth indicators in terms of indicating which stocks are over their 20-day, 50-day, 100-day, 200-day moving averages. Also in terms of volume, not quite supporting this move up. So you can see how much lower the volume's been. And this pretty much says that institutional money is not driving this. It's more sort of retail money that's driving these rallies as opposed to institutional money. When we start to look at the sector performance, we can see it's 100% tech and specifically semiconductors that are driving the rally. So when we start to, and we look back from the 1st of January this year, if you were in financials, health actions, and US stocks, you'd be down year to date. If you were in utilities, consumer staples, property, industrials, or materials, you'd be slightly ahead, but nothing to write home about. But tech is the thing that has really rallied over the last 6 weeks. Energy has come off its highs, its March highs. Energy has started to retrace a little bit with sort of a softening of oil prices, and we've seen a bit of softening of energy stocks. And they had a really good rally, and nothing goes up in a straight line, and they have retraced a bit. But it's absolutely a semiconductor business. So when we see, once again, it brings us back to breadth. We're not seeing broad sectors participation within this rally. We're seeing very much a technology and specifically a semiconductor concentration that's really driving the moves up. When we start to look at why, we understand a couple of key things. Like since the Iran war started, and when we take different sectors and we take different components of the world markets, and we do a comparison relative to the S&P 500 performance, we can start to see that technology has absolutely outperformed the average S&P 500 performance by 22%. Bitcoin and Ethereum have actually outperformed since the war started, 17 and 15% better than the S&P 500 performance. The Kospi, the South Korean markets, which is very much hardware, chips and memory, they have had an absolute banger of a period, and they're up 11.2% better than the S&P 500. And when you start to look at what hasn't really performed is utilities and financials and industrials and energy, all of those things, the consumer staples, the healthcare, and even coming down to gold and silver, have significantly underperformed the S&P 500 since the war started. So what is driving that, you may ask, and what's driving it is the earnings. And I touched on the earnings last week in terms of when earnings are continuing to improve at such a rate that they're improving quicker than what stocks are going up, the valuation stays intact. And what you can start to see is when you look at the 500 companies in the S&P 500, at this stage 409 of those have reported. That's an 82% reporting rate, of which 87% of those that reported have actually beat expectations, which is phenomenal. And when you go to tech, 47 tech companies have reported, of which 98% have beat expectations. So in other words, 46 out of the 47 tech companies beat expectations. So what tech is absolutely flying, it's absolutely the narrative in terms of AI and robotics and the whole leading to automation and data centers is all pretty relevant. But the main difference between now and the tech bubble that happened in the late 1990s is we're actually getting the results. The earnings are justifying the valuations that we're seeing in the stock markets. Now, that doesn't mean that everything goes up in a straight line. As I mentioned, we're seeing weakness, we're seeing lack of participation, we're seeing volume declining, right? And inevitably we're going to have a pullback. Now, what we're wanting to see is a bullish pullback, reset some of that momentum, probably come back to these sort of levels here where you did have broad participation, maybe potentially flipping this resistance into support, and then potentially having another leg up. When we start to look a little bit closer to home in the Australian markets, we are seeing a very different market. And the ASX is down 0.5% this week. We're at 5-week lows. Financials are absolutely being torn apart. They're not looking good. Banks are between 1.3 and 7.7% down for the week. Our Australian dollar against the US dollar is grinding higher, but starting to lose momentum. And when we start to look at our CPI from a budget forecast, they're expecting us to hit 5% by the middle of this year, by June, July this year. But when we look at the difference, I love to look at risk sentiment. And what I've got on these charts over here is XDJ over XSJ, which is the Australian Consumer Discretionary Index over the consumer staples. And what this pretty much tells you is when discretionary outperforms staples, you have a very risk-on environment, a very risk-on sentiment within the market. And when it's in a downtrend, it means staples is outperforming discretionary, which means it's more defensive. And what you can see is since the bottom of the 2022 bear market, we've been predominantly incredibly bullish up until we got to sort of October last year. And when we got to October last year, we started to understand that the RBA had lost control of inflation. Inflation was becoming very, very sticky. And when inflation becomes sticky, there was a real chance that we would see rate increases. And so far this year, we've had 3 rate increases. And that has created a very risk-off environment, right? Which is slightly different to the US. The US have had longer periods of risk-off based on different things that have happened. And from the Trump's inauguration through to the tariffs, the US markets saw risk off for a longer period of time than our brief foray down. But what we're starting to see now is we're starting to see a little bit more strength, a little bit more risk in the US markets, driven by tech and driven by consumer discretionary, which we're not seeing in the Australian market. The Australian market, we've been in real free fall in terms of discretionary against staples, really indicating to us that we have a very strong risk off sentiment. And that's been driven by the oil issue in Iran. It's certainly been driven as well by the budget that we've just delivered in terms of negative gearing restrictions and changes in capital gains tax. That has certainly impacted our markets. We've certainly seen banks lead the weakness, and we're sort of down across the board. And what we're starting to see is a little bit of a move, but we're also coming into a key resistance level here. So until we actually clear that level of resistance, we can't really say that we are turning risk, getting a risk on environment again. Right? We're still very risk off, and we have to sort of reclaim that support resistance zone. Now we got the Beijing summit happening at the moment, where Trump has got 17 leaders and CEOs that he's taken through to China. And that's actually going to be really key for the Australian market, because Australia supplies China to a large degree. And if a whole lot of deals can be done in terms of business deals and capital rich deals into China, that could wake up China, because China's pretty much battled from an economic perspective since 2018. They really have struggled. And we are in a nice commodity cycle, but we're really reliant on supplying into China, and China's demand is incredibly low right now. Our sort of commodities are a little muted compared to what they potentially could be. So this Beijing summit outcome is actually going to be a real catalyst that could either reverse if it goes negatively, or accelerate our performance and what we might see in the changes. Now, when we go into the Australian markets, it's very similar to the US markets. It hasn't been great for most sectors, and most sectors, especially consumer sectors, because of the RBA putting up rate hikes, have felt it really hard. Technology has sold off pretty hard, trying to get a bit of a recovery bounce, but selling off pretty hard. And healthcare in Australia has been terrible. And there's a lot of healthcare that are at absolute bargain prices right now, but we're not seeing capital rotate into them yet. And we need to wait to see that capital rotates. And I don't think the market's ready to go into healthcare yet. And maybe we've got a little bit more time in materials. So materials and energy is where the money is at. And if you've been in materials and energy so far this year, you would probably be pretty happy with your portfolio. If you were in anything else, you probably wouldn't be that happy. So materials and energy are really good, but the biggest thing that we're starting to see, so even though we are a little bit risk off, we are still a little bit risk on. And where we're starting to see that little bit of risk on is when we start to look at the different cap sizes in the Australian market. So when you look at the XTO, which is the top 100 stocks, they're actually the worst performing since over the last 12 months from last April's low. When we look at mid caps, they're slightly better than the large caps. When we look at small caps, they're slightly better than the small caps. But when we look at micro caps, the emerging companies, we're actually sitting with really good growth. They're up 56% in the past year. Now, if you know anything about market structure, we normally have 3 phases up, or what we call in Elliott wave 5 waves up. And since the April lows, we've had wave 1, wave 2, wave 3, wave 4, wave 5. And after you have 5 waves up, you generally have a correction that corrects a lot of the gains that were made in the 5 waves. So you get your 3 waves down. And that's what we've pretty much seen here is micro caps that are very much driven by material stocks and also some energy stocks have actually performed incredibly well. And we have had a bit of a reset, and we're starting to see a clear divergence now, where we're making lower lows and lower highs on large caps, mid caps and small caps, but we're starting to show some strength again in micro caps. And that's a real opportunity for us to look in. So that's a bit of a wrap up of what I'm seeing in the markets, the US markets versus Australian markets, how they differ. Hope you found it useful. See you next week. Bye.